Welcome back to the Make It Your Business podcast. I'm James Murray. This is
Duncan Casey.
And today we're going to talk to you about the GGS scheme, which you're probably thinking, what's the GGS scheme? Well, it's the Growth Guarantee Scheme. It's something that's been initiated from the British Business Bank, and it's a type of loan really that the businesses are being marketed to quite a lot. So we're going to kind of go into the details of that, debunk some of the myths around it, and also explain the alternatives as well, because I think there's a bit of confusion when it comes to this type of product. So I think what we'll do today is, Duncan, you've probably got a few questions. I know it's something touches on a few things that you've been looking into yourself.
Yeah, I was just, and also to set the stage and full disclosure, this is me getting some free financial advice as well, because I wanted to, I want to discuss this with James a lot, because I'm considering doing this, trying to put together some ideas about how to deploy it and all that kind of thing. So hopefully you can live vicariously through me if you're a business owner, if you're thinking about how to get investment in your business and whether or not a government-backed loan is the way to go or not. So.
Yeah, I think that's the thing, and like probably every business owner that's watching this or listening to this has probably been emailed or marketed to with some sort of government-backed loan, and I think the word government has been used quite cleverly by marketing companies. I'm probably there myself, because it does draw interest, but it shouldn't be mistaken with grants or free money or anything like that. So these are sort of conversations I have. I probably should add, this is not financial advice. This is consultative conversation. I'll share my knowledge. I do arrange these loans for clients. This isn't exclusively through my business. You can get them through other brokers as well. But I'll share what I've done, what's been a success, what has worked for certain businesses when they come to me, but also the conversations that I have around alternative products, because actually you'll be mad to hear, but having a government-backed loan isn't always the best or the lowest cost option. You would probably assume that it would be like cheaper money than anywhere else. But okay, let's start. Yeah, I mean, actually, can we start with the marketing side of it? Because I've got a bit of an sort of, as I say, a bit of an issue with it.
Okay.
So I think the problem with this at the moment is, ever since we had there was a thing called CBILS. So I guess maybe going back onto the history of it as well. So originally, during COVID, there was a thing called CBILS, which was the coronavirus business interruption loan scheme. And that was pretty much like a free handout. It's sort of unheard of, and hopefully is going to be an anomaly in the future. We won't see anything like that again. But it was where the government pretty much initiated banks to lend money at very low rates. This was not still free money, but it was such a good deal. I think pretty much nearly every business took these loans out. And then after that was replaced by a thing called the recovery loan scheme. The bounce back loan. So then there was the bounce back loan, and then it was the recovery loan scheme. Right. And gradually these were watered down versions, and some lenders decided to opt in, some decided not to. And now, as of this year, we had the Growth Guarantee Scheme, which is GGS. It's known, so it stands for Growth Guarantee Scheme.
Yeah,
and essentially what it is now, it's been watered down so much that some lenders have decided to onboard it because it helps them lend more money.
Right.
So it's a product where you can, they'll say to a traditional sort of loan provider, how can you lend more money? And they then back it by 70%. So they sort of say, lend this £100,000 out, and we're going to protect 70% of your investment into that company. So that then gives a broader scope for that lender to lend more money out to the business. Right. There's obviously other variations with it. Won't go into too many specifics, but there's also the fact that as the consumer, as the business taking the money, the personal guarantees that are required are watered down, so they can't come and take.
Most people, it's like, don't take my house, right?
Sort of, it's your main primary residence. Now you can find all this information on the British Business Bank website, and it will go through all of the terms and conditions, tell you, the amounts you can get. It doesn't necessarily fall just under unsecured loans, although that seems to be the big majority of inquiries I get. But it can also be an invoice finance. It can be for other types of products as well, asset finance. So it doesn't need to be unsecured loans solely. But there are some benefits to it, and it was put out with good intentions. So I think, but the problem is, going back to the marketing point, I think what's happened is businesses, brokers like me, lenders, they've kind of jumped on this as a marketing opportunity.
Right.
And why I get frustrated is I think because they're jumping on it, playing that it's sort of a government initiative, then clients are assuming that it's going to be the best deal for them, and then are not necessarily scoping out other options.
Okay.
It's then also potentially confusing with other products, maybe grants and the small business loan, which I know we've discussed before, which is something you get directly via Gov website to apply for. So it shouldn't be confused with those sort of things. So my whole thing is about just transparency and just going through all of the options. Just because it's a GGS loan doesn't mean that it's going to be the best deal for you or the most appropriate product for your business.
Yeah, because you're right. I mean, I think it's important to stipulate this is not, I mean, it always annoys me when people say government money, because it's not government money, it's taxpayer money, right? So the government doesn't actually have any money. Sorry to say, like Cumbernauld isn't just a big sort of DuckTales money vault that Keir Starmer can, pay for things on. It's taxpayer money. In fact, there's not even any money there because it's a credit system, and we're deeply in terrible amounts of debt. That's a whole other podcast. But but a lot of this government backed loans and stuff is still banks lending, right? But it's just the government is putting up the guarantee, if you like. They're
guaranteeing it. So they're piggybacking the infrastructure that's already there. So let's say, for example, you've got a lender that has a certain criteria where they say, we take businesses that are trading for 3 years, have got 2 years accounts, they've got to have, and we will lend 100% of their monthly turnover. Or they may say we'll lend 2 times their operating profit. Each lender will have a different algorithm that they work to. The idea is then to increase that scope slightly. So they'd say, and it's not to open the doors wide to lend to everybody. It's normally a 10 to 15% deviation on their normal lending criteria.
Right.
And obviously it's to inject capital into businesses, to promote growth, to promote the economy. And so that's the idea behind it. And it has been relatively successful. But as I said, it has been watered down year on year, really.
Yeah, I think it's to remove the. I mean, look, we're homeowners and family men and all that kind of thing, and obviously there's going to be a lot of trepidation, especially from partners and stuff like that, when you're putting up your house as collateral against a loan to fund a business that isn't proven. Of course there's going to be pushback and there's going to be reticence to start businesses, therefore, as a result. That's the only way you can get, or not only start businesses, but obviously get businesses from being a sort of very low with single, essentially a limited company with one person working in it, to try and grow it. So I guess growth guarantee scheme is I don't know about the word guarantee. I think that's a bit of a mistake.
Well, the guarantee is for the lender more than anything. Yeah. So I think what happens is, and on all the paperwork, it will always say that you are still 100% responsible for the loan.
Yeah.
So what happens is, let's say you've taken out £100,000 and it's being recalled. The bank will still come after you for the full outstanding balance.
Right.
What happens is, if you then don't pay that back, they then fall back on the 70% guarantee. So there's still a lot of legalities and things to go through. So and again, these are the things that you just need to be aware of, just by thinking, oh great, they can't come and take my house, I've got no responsibility.
Yeah, but you'd have to declare bankruptcy, wouldn't you? Or would you have to declare bankruptcy? Yeah. Exactly. So it wouldn't be. It's not like, oh, you go, I'll cry.
I'm not a lawyer, but then that then brings into question, how safe is your house? Because if you're then being made bankrupt, what other things you owe? So, I mean, essentially, again, I don't know the ins and outs and the actual full reclaim process, but I would imagine, I don't know how thorough the bank has to try and reclaim their 100%. I mean, even if they can get to 30% and say, job done, we've maxed out, we got as much as we could off the director, can we have our 70% now?
Yeah.
Then they're clean, and I would imagine that the guarantee would then fall into place.
Because if you're guaranteeing 70%, you're not just guaranteeing, like in the 100 grand example, you're not just guaranteeing 70 grand, you're guaranteeing 70 grand plus interest, right? So it's kind of...
Yeah, and again, I think it depends on the, you're responsible for the full interest, but I think in these situations, the banks will just try and reclaim as much as they can. They obviously, they know that they might not get 100% of the proceeds back, but they'll try and get as much as they can.
Not to go, I don't want to divert too much into a tangent, but it does, while we're talking about percentages and stuff like that, obviously when you see things like Dragon's Den or angel investor scenarios, oftentimes they talk in terms of for X% ownership of your business. Is it right to think of these loans in those terms as well, in the sense that they're essentially going to be reclaiming a set amount each month of your turnover, which effectively puts them... I know they're not therefore shareholders or anything, but they are... I don't know. I always try and see it in terms of like, well, you're going to therefore have claim to certain amounts of my revenue until this is paid off, which makes you kind of, in part, an owner of part of my business. Yeah.
I would say they're very different.
Yeah, okay.
I wouldn't look at them the same at all.
No.
Because with an investor, I think, and it's something I speak to clients about all the time, or an angel investor or a dragon, whatever you want to call it, they are taking normally an equity, and normally it's not necessarily like a joint venture where there's a buyout or something. It's normally they've got
in perpetuity.
A shares in your business. Quite rare that there'd be B shares or that. So if they are doing that, the short term repercussions of that might actually be better in the fact that you don't have the immediate repayment of that to go out. You might get the support. So there's a whole nother conversation about investors versus debt. But in short, you over the long term, if both scenarios are successful, you could end up paying 10 times more.
Yeah.
Because of you've shared the value of your business. Yeah. So it just depends on the unique aspect of the deal. But I think with debt, it's a fixed period. It's normally a fixed interest rate as well.
Yeah.
So if you're doing that, you can really project exactly what your repayment is going to be. I really recommend everybody fills out a detailed cash flow forecast and a business plan to work out how that debt's going to be.
That's something we should do future. We should do an episode on because again, cash flow forecast. These are all things that people talk about and assume everyone knows how to do that. Whereas I would have to look that up.
Shameless plug here, but if people go to my website, I've got a free download for a cash flow forecast. You can get www.jamesmurrayfinance.co.uk. You can download it and fill it out and see what it's all about. Just even if it's just an exercise you want to carry out, and
definitely worth doing.
But yeah, it's really good because obviously, I mean, it really works when you've got a lot of cash turning through your business, a lot of payments going out, a lot of payments coming in. But on top of that, just working through how that money is going to get to work for you. When you're borrowing money, you're paying a premium for it. So it needs to be actively working to help your business grow or get the objectives that you need. So whether that's investing in people, those people then need to return you a profit, or they need to be productive and help with the infrastructure and the systems to help that business go to the next stage. So anytime you are taking out debt, whether it's a GGS loan or it's just a standard loan, or you're taking out asset finance, if you're buying a van and you're financing it, the van is being put to work, isn't it? So it's being worked, it's going around, it's carrying tools, whatever it is. It's a useful asset, which means the debt is being productive. And I think it's all about that money being productive. There's no point taking anything out and it just sitting there, and then you repaying the repayments just on the balance sitting there. Because
I mean, and that brings up another thing: is there's operational costs and there's investment. Because and this is where you need to think about your specific scenario, and this is the sort of homework I'm doing at the moment, is that how to deploy that debt in order to get the fastest ROI. Because, so for example, in the case of a van, if it's a business that is, I don't know, whatever, a plumber's business or someone who needs a van, it's like, well, if you've drummed up enough demand that the supply is struggling, the operation is struggling to meet, then obviously having that injection of cash to then just get another van, get that to work, blah, 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 no brainer. But if you're in a position where like I am, like basically service based, I mean, it's a bit different with video marketing because obviously you do produce a product, but it's yeah, I guess it's servicing a service at the end of the day. And realistically, I would use a loan at the moment to help increase, turnover and bring in more business.
But it's more of a there's not as much of a guarantee on that. Whereas if you are buying a CNC machine, so CNC machine is a cutting machine, you're buying that for a purpose because you've got a certain amount of work that needs to be fulfilled, and that is going to enable you to send invoices out to get money in very simple terms. And whereas when it's more speculative, if you're getting funding for marketing for non-tangible products, it's a lot more high risk. But that's then when we have this conversation about, are you going to use some of your own funds? Are you going to use, and I think people think, oh, well, I'll take some government money. Well, it still needs to be paid back if it's not a grant. And I think that's the thing. This isn't a grant. This is and GGS, by the way, can be used for asset finance, as I say. So let's say, for example, you were a plumber, and you just fell outside of the usual criteria for a tier 2 funder that might be able to offer you some finance, and you're struggling to get finance because you've maybe got a couple of black marks or a few missed payments on your profile, but there's enough there, but it just falls outside of the scope of what a traditional lender would lend you. That's where then GGS kicks in. So an asset funder that is taken on the growth guarantee scheme, they would then go, okay, this profile, this plumber, they're a bit risky for us. I tell you what, just to make us comfortable, just to tip us over to doing the lend, we'll initiate the GGS, and that's where it does come in on asset finance. With the unsecured stuff, it really does come back to that. It comes back to that business plan. And even then, when you are looking at the unsecured loan on GGS for that, you need to really see how you're going to be deploying the money. So most of the unsecured funders that I work with, they're happy for it to be used mainly for the costs of employment. So maybe recruitment costs, onboarding, IT infrastructure, all the things that go towards it. But they do not want it to pay salaries. So because that's not seen. So you've almost got to evidence that there's a serviceability there, and that the money again is being put to work. That's what most lenders are looking for. They're looking for it driving growth.
Because I think my approach, and tell me if this is wrong, but my approach would be to try and have some kind of proof of concept there with your own resources, if not money. But like that thing of, look, I spent this on outbound on LinkedIn, and I spent, I've used the free version of this CRM, and I've managed to drum up X amount and blah, blah, blah. If I had that extra cash and I put that behind it and sort of turbocharged it, if you like, with that money, I could see a faster rate of return, and if you can crunch your numbers on what you've done already with what you've got. The problem, GGS versus that's basically government backed loan, right? So because the ones I've looked at, you can only get up to, you have to be a startup, so you can have been trading up to 3 years. But the problem with that is like, then you've only got 3 years to kind of prove, So
you're talking about the new business startup loan.
Yeah.
So that's a completely different
That's different.
thing.
All right,
it's a really, we probably should touch on it because it is.
Well, I want to talk about that because that's something I'm looking at very much. Is that too much of a pivot to talk about that now?
No, I think it's relevant.
Okay, cool.
Yeah.
So you can only get that if once you're trading over 3 years, you're no longer eligible. My thing with that, because of what I would want to use it for, is that I don't feel like I've had enough time to sort of trial and error outbound, sales, investment stuff. But that's what I would use it for, because that's what I would need it for. So that is a fixed rate of 6%, which seems quite reasonable, and you can borrow up to 25 grand per director. So if you've got multiple directors, you can borrow, multiples.
Because it's a personal loan, effectively.
Right.
Now, normally when you go and people do this, obviously I can't advise that you do it because when you go and get a personal loan, they sort of say to you, is this used for personal purposes?
Yeah.
Whereas the business, this new startup business loan via the government is a personal loan for business purposes.
Right.
So it also gives you some mentorship and things like that as well, which they offer. You apply directly via the Gov website.
Yeah.
Now, I've found that this is sort of a hybrid between bootstrapping. So, for those that don't know, bootstrapping is self-funding your business. We've talked about bootstrapping.
It can include like getting family loans and that kind of thing, right?
Yeah, exactly.
But basically
so
not
it's anything.
taking any...
But even bootstrapping, you are taking a risk,
Yeah.
and taking a personal loan to start a business, it's a risk. So again, with that, you then need to know your own risk tolerance and have a solid idea that you're going to be able to at least pay the money back, or it get you going. But the good thing with that is the rates are quite competitive. At time of recording, it is 6%, and they are. It's a really good way. Obviously, it's maxed at 25,000, so it's not going to be appropriate for every business. But if you've got a new startup business that needs more than 25,000, that actually is probably the time you're looking at investors. Because if you've not got your own money to put into it, then you probably need a partner, or somebody that can come into the business that can you offer the actual production, the ideas and everything, but somebody else offers the capital, and as a partnership, then you start a business if it needs more than that. But yeah, if you've got a media company and you think, I could do with getting some new equipment, I've got some really good marketing ideas, I'd like to invest £1,000 a month into LinkedIn marketing, but I know that won't see a return for the first 6 months. I'd like to recruit an outsourced marketing agent. I want to get into some high-end membership clubs. I don't know. We could do.
That is again. That's something I having tried as best I can to stress test the various ways I would deploy a loan like that. One of the things that comes up a lot is join Soho House or join one, and you go like, wow, what a way to pee away $2,000, but actually, it only takes one conversation, and those are the kind of things. But again, that's the sort of level of risk and speculation.
Exactly.
You're
it's
talking
hard
about.
to finance that because it's the sort of non-tangibles.
And it feels like a jolly.
Yeah, whereas if you are a new startup plumber
Yeah.
and you need a van, you need some tools, it's a lot easier to it's a lot more obvious. You might even already have some orders or some client book ready to go. So
and it's a thing you can sell ultimately and get some of the money back.
Absolutely. Now, the thing to touch on here, this, I'm not saying that this is 100% factual, but from my experience, and this is a behind the curtains hit thing here, we need to talk about being a homeowner.
Right.
Because everyone I know that's applied for the government loan directly, so this is the startup loan, if they're not a homeowner, I found that they've not been successful.
Yeah.
The ones where they've got a good business model and they're homeowners have been more successful. Now, I've got they don't put it on the website. They don't talk about it. So this is just my experience from what clients I've spoken to have found. Now, in my experience through lending or arranging loans for other businesses through GGS or through just standard unsecured and business loans, the return rate on loans from non-homeowners to homeowners is significantly different. So tenants and people living with family, I think it's something like 5 times more likely to default on their business loan than a homeowner. So it actually doesn't have anything to do, because I always used to make the argument, well, you could be a homeowner and have negative equity.
Yeah.
You tick a box as far as an algorithm is concerned, but you could be a tenant with $100,000 sitting in your bank account, but you've officially not.
Yeah, and it's not secured against. I suppose the point is you've been approved for a mortgage at some point, and I guess that's.
Well, I used to think more, but I think it is purely just a statistics, and I think the banks are on that, and they can't move away from the fact that statistically over time, tenant directors have got a larger default rate, so they then kind of prejudice all tenants in the same. And I think I'm assuming that the startup loan does exactly the same thing. So one of the biggest challenges I have is arranging funding for non-homeowners for their business. Car finance is different, but for business loans, that's then when asset finance can really be quite advantageous, because we've kind of got these like 3 pillars, and you need to kind of pin something to it. Ideally, you want 2 of the pillars at least. So that's the directors worth in themselves. So being a homeowner, their own sort of credit score, that sort of thing. There's the business's trading history. So has it been trading? Has it got profits running through the last few accounts? Has it got an upward trajectory in its turnover? All of these sort of things that you look at when you're looking at the management information of the business. Well, on a new start, you haven't got any of that. It's not your fault. It's just the fact you've got no evidence of a proven track record. And the other thing is the asset. So if it's an unsecured loan, you've got no asset. You might not have a business model yet or any proven track record. And if you've also, as a director, not got any great credit profile, or you're not a homeowner, it makes it incredibly difficult. And even on the government's
I can see that. I mean, to be fair, I suppose if you're looking at a loan that is really there for people who don't have those track records, what else is there? If you have a home,
and the frustrating thing is, I do speak to some people, and they've got some really good business ideas and business models, and for those people, generally, what I would then say is, you need to find a partner.
Yeah,
you need to sell yourself. You've got a good idea. You need to go networking and find somebody that's willing to back your idea. You are obviously going to have to share some of those profits, but at the end of the day, if you're not going to get the business off the ground anyway, but they can also help with mentorship as well. So that can sometimes be another advantage to getting an investor on board.
Yeah, well, it's the sort of Dragon's Den model.
Yeah,
exactly. Yeah. Okay. All right. So, is this worth and we can cut this out? And I know we're trying to work to a framework here, but we want
to miss anything, do we?
I'm using me as a case study. I just made some sort of unwieldy portmanteau there, unwittingly. So say in my, you know me, you know what we do, you know my sort of roughly my kind of my ups and downs over the last few years. If my plan would be to take a loan of say 15 to 25,000 and invest, as we talked about, in hiring an agency or an individual who can literally just be doing what we all hate doing, which is outbound lead generation, contact, just doing that, maybe even doing the phones as well. And that's what I've got to get, because I've got to get some more business in. But obviously I would want to spread my bet, if you like, so I wouldn't just put the whole loan into that. I would go, well, I also need to have some reserved for ops, because I can't, not necessarily employing anyone, and I do have people who can fulfill a lot of that, but there are gaps in that so and so might not be available at that time, or blah blah blah. So there needs to be some held in reserve. There also needs to be that, but I mean, I think it's sensible to hold back a percentage to repay the loan to begin with. Not that I'm suggesting that you should borrow money to pay back borrowed money, but I think you need a buffer. You can't just in month one blot out all this 25 grand and then you've got like a whatever repayment. So in my case, you'd say it's going to take 3 to 4 months to realize an ROI from what I'm going to start putting in place, because there's also the setting up of things, there's the setting up of a CRM, the capturing of blah blah blah. And I know this is not financial advice, I'd just like to clarify that before we go any further. But what do you think, the startup loan would be a good way to go, or would a GGS be a good way to go? Or?
For that circumstance, the startup loan's perfect, because I think the rates are incredibly good. I think, again, I'm not quoting the exact figures, but I think borrowing something like 25 grand, you're paying something like $1,000 a year or something. It's really good.
It wasn't even that. I think when we looked at, if you did it over 5 years, it works out, the cost of borrowing is about $3,999.
I think there's a calculator on the list.
There is,
Please check it.
It's very,
don't quote our figures, but it's really competitive in comparison to standard unsecured loans anyway. So
what's a typical rate?
It's probably normally at least double that.
Really? Okay.
As far as for an unsecured business loan for a perfectly good business. But so I think as far as that side of things are concerned, the fact that you get the extra mentorship if you want it and all of those sort of things is really good. As far as like a business sort of business plan is concerned, I would never recommend that anybody say as part of an application that's part of the loan is going to be to repay the loan.
Okay.
That obviously practically that might be the case, but And in a way, you're trying to be quite smart and forward thinking, and not being, disillusioned with the fact that it's immediately there's going to be income, even if you're not being deluded with your with your business model, and you expect that there is going to be an element of time before that money comes back in. So even if you won a job on day one, you've still got to invoice it, get paid for the invoice. So I'd probably say, using some of your original seed capital as well as a float. I think just relying solely on the loan, I think putting some of your own investments, some of your own savings into it. Again, I always think as part of outside of just the standard business loan, you are, and especially with the GGS loans, if you've invested some of your own money into the business, it shows that you believe in it.
On that front, because here's my attitude towards it is that I've got the business going to the point where we've been trading for nearly 3 years, and I've managed to keep it going with its own money effectively. Like I think to begin with, I put some of my own money into it, but basically I brought in jobs and built up some capital in the business to the point where, and I'm used to it sort of having to live off that and have it fund itself and that kind of thing. So my attitude would always be keep doing that. Yeah. But the loan money coming in has to be sort of ring fenced and deployed for purely growth purposes. So that's my attitude. But I suppose what I'm doing is I'm playing devil's advocate with certain, because obviously there's that lag that you talked about. There's a kind of mechanical loss, if you like, in the system, which is you've got to invoice, you've got to win the business, then you've got to do it, then you've got to invoice it. I mean, we always charge a 50% deposit anyway, so because that's the way I kind of essentially fund the operation of the delivery, and then, but I think if you're going to have to expect that I suppose what I mean is that in ring fencing that money to be purely for that thing, I'd also probably think about whether or not you say, okay, here's my capital that I have now, and I use some like the job of that is to repay the interest effectively.
I probably wouldn't go to
am I overthinking? Yes.
I wouldn't overthink it. I think look at it as project money.
Right.
I think and again, I'm not telling people how much to borrow or being irresponsible to tell people to borrow more than they should, but maybe also account for increased costs. So it might be that you want to add 10%, because what you're not going to want to do is keep going back to take more. For example, if you were thinking of taking 15,000, just maybe assess those costs, think what is the worst case scenario, because actually the monthly repayments taking out another couple of thousand might be insignificant in the grand scheme of things, instead of having to go back later down the line. So, and again, because of the rates that being quite competitive, you probably want to utilize that as much as you can, because you're not going to be going back for a second bite of the cherry. So,
and would you max out the time, or would you?
Yeah, potentially. Again, it's circumstantial. It depends on your business model. I'm inclined to say yes, because of the monthly repayments. So cash flow's king. So if you can keep those payments down, you sort of just get used to it as an overhead of the business, rather than trying to repay it back really quickly. I think it's sort of a relationship with debt sometimes. Sometimes people have a thing, I need to pay the debt off quickly.
I do. I don't like, because it's going to cost me the least if I do it.
Yeah, and it's like, our parents obviously, I was the same thing. They say, debt is bad, and I think that's a really good foundation, because it means that you're not going to necessarily be irresponsible, but you then potentially miss out on opportunity. So as long as you're responsible with it and you treat it as part of the business costs and it's sustainable, then absolutely, just make sure it works for your business. And as I said, that effectively, if it was £4,000 worth of interest, are you going to make that back? Are you going to obviously repay the loan, but is it going to activate at least £4,000 worth of profit? And it's really just trying to get a return on investment.
I mean, I suppose when you put it in those terms, for example, with our business, if I landed the job to do, a sort of hero video for a client or something like that, then in 5 years, which is how long you can borrow over, and that would cost just under $4,000. Yeah. if I could just achieve one of those jobs, it would essentially pay off that interest. So
exactly.
Yeah. When you think of it like that, it depends on your business model.
When I'm talking about debt, whether you're borrowing £10,000, £100,000, or $500,000, it's still the same principle. Like, the money needs to be working for you. I probably sound like a broken record here, but as long as you can, and there's always an element of risk. There's no guarantees in this world. There's no guarantees with business. I mean, any entrepreneur, any business owner knows that you didn't start a business because it was easy or because it was risk-free, but you took it because you decided to do it because you wanted the liberation of running your own business and you wanted the untapped potential. And, well, might be speaking for people there, but I think that's generally one of the core motivating factors of
100%.
Starting a business. So you have to sacrifice a lot up front, but you potentially get bigger rewards down the line and during. And but this is just another sacrifice. It's another risk factor that you have to account for. And if it's done responsibly, I always say, if you've got a good accountant, they'll run the numbers for you as well. So talk it through with people. Talk it through with another business owner. A proof of concept. Anything where you're trying to. I'd say most businesses that I speak to have been trading a little while. There's a proof of concept that they know where the funds are going to be deployed. So it makes my job a lot easier because of the proposal write-up. With the New Start loan, it's a bit different because it is probably more of a business plan. Yours is unique because you're a bit further down the line. So I would assume that yours will be successful. But yeah, it's my recommendation to anybody, and kind of put it back to the GGS loan, really, and the growth guarantee scheme, you still need to treat it like any other application. The funders want to see that you are, a responsible borrower, that the funds are going to be utilised in the appropriate way, and effectively it's going to be repaid. And you still have all of that work. I mean, my write-ups, when I do an application, this is one of the things I'm trying to educate people on. Just don't click those links. Don't just, if you get email advertising, and you will have had it, if you're still watching this and you're a business owner, you will have had an email this week saying, get X amount of money, just click here, 2 clicks away, have the funds in your account in 24 hours. That all sounds great, but at the end of the day, it shouldn't be treated like a comparison site. Get shopping for your car insurance. It really shouldn't. It's detailed. Each business is unique. Each business has unique challenges, and it requires somebody to look at it in detail and explain the different solutions to businesses. So let's say, go back to the £100,000 example. What I would do with a client is I would sit them down and sort of say, okay, right, what are the funds being used for? In the first line, I might hear that they're buying machinery and equipment and doing a shop fit out. Well, they don't necessarily need a short-term, quick 24-hour loan. Of course. They need something way more structured. Then there's a whole story, a narrative that I then get to understand. And the benefit of that is that it might have a lower cost of finance. So the interest rate might be lower. Well, then might attach it against the assets. So although they might seem like they're not assets they're buying because it's shop fittings and things like that, and mezzanine floors and that sort of thing, well, these can still be treated like asset finance. And it can also be done on the GGS loan. So what we might do is that actually say, look, there's an option A, which is a GGS loan secured against this and this, but here's the downside, it's a bit more expensive, but we've actually got this other option B, which gives you a bit more availability, a little bit extra cash in the bank, and it's lower cost, but it's got higher but there's more security, and there's more the personal guarantees are more thorough. And by speaking with again, I'm going to say this, I've got a vested interest in somebody speaking to a broker, but if you also go to some of those online platforms, they have a marketplace themselves, and they might shotgun your proposal to many other funders as well. And it might not even be for GGS, and you might just get, you've been approved for this, or this has come back. And then if they speak to a broker down the line, sometimes my hands are tied because I can't then approach some of those funders for a set period of time because they've already been approached. And even if I could, there's already a proposal. Let's say they've been declined on finance. They may have been declined based on that business not taking the full story. So whereas I might then have this full narrative of the reasons that the cash flow dipped last year, and also you've got negative shareholders funds, but there's a story behind it. I can explain why that is, and trying to pigeonhole it to the right funder. If it's just been sort of a algorithm-led online platform where they just shoot off your proposal based on core information, that decline has been based on that information. So when you speak to a broker like myself, we end up looking at a much more we take a much more holistic approach.
Yeah.
Look at the whole picture and then work out, rather than that shotgun approach. It's much more of a sniper approach. So we identify the most appropriate ones, come back with a few solutions, and then present it. And some of those might be growth guarantee scheme, and some might not. But I think, going back to the point we made at the very start, just because it says government, just because it says government backed, or it's growth guarantee, the word guarantee, they can be a bit misleading. So I think it's just about reading the small print, speaking to a broker that you trust. Doesn't have to be me, but somebody that you feel has got your best interests at heart, and then going through the options from that, slowing down a little bit. Doesn't mean that it's going to take months. You can still get, I do funding agreements that first contact has been on the Monday and it's all paid out in the same week. So it's not like it's going to be slow. It might just be a little bit slower, but you get so much more. So
well, it's
that's
worth taking the time. I mean, if you need a loan that quickly, then I would suggest it's probably not for investment. It could be an opportunity that's suddenly come your way, I suppose.
A lot of 90% of the time you've waited too long. So around, it depends on the time of year. Quite often going into sort of the winter, some businesses, construction businesses like that, they might get their corp tax in January, and a load of outgoings go out and in over that period, and then they come to me at the end of January or February, and they're in a worse position than they would have been if they'd looked for funding in October or November.
Right.
So actually, if you can foresee, and again, this is where the cash flow forecast comes in, and looking ahead, if you can foresee a bit of a hill on the horizon, prepare for it before you've started walking up it, because you're going to be in a much better financial state to be able to get better costs of funds, better options. Your accounts are going to look healthier. So when we go and get the funding, it's just going to be a much better case study than going when you've already had some missed invoices, you've got some bounce payments, you're late on your corporation tax, you've had to take a time to pay on your VAT or something, all these things that then are red flags to lenders. So if you feel that you're about to go through a period of instability, or a period of where you working capital might be a bit tight, just prepare for it ahead, and as long as it's done responsibly, and you and again, that capital could be deployed to help you through that period anyway. And we're talking about all sorts of things. And again, it's not necessarily an unsecured loan. It could be asset finance. It could be invoice finance. It could be it could even be an investor. Even if you're approaching an investor, you're much better approaching him or her before saying, I'm about to go through these projects. I'm fearing that I might potentially be over trading soon because I've got all these contracts I want to win, but the payment terms are really long and I need to deploy all the money up front to get the jobs in progress. Would you like to do a would you like to do a JV, a joint venture on this deal, or would you like to you could become an investor in the business? Much better doing it at the start, because it shows also that you're thinking of these things, and you're again a responsible person within the business.
100%. Well, what do you think? Have we? I think we're over 3/4 of an hour on that. I think that's quite a good good place to.
Well done to anybody that's stuck through it. I mean,
there's so much to unpack here,
and I could talk about it all day. Really.
And it's great, and I hopefully that's been really useful for anyone who's. It's certainly been useful for me, and I sort of see myself, I suppose, as a proxy for a lot of people out there who are in the same sort of boat. If you are thinking about and I think we can get into the nitty gritty on how to deploy it, and certainly I'm at that stage now, and I am teetering on the edge of what I do with it, and so obviously we'll we can do some more episodes on kind of documenting how that goes for me over the next few months. I mean,
again, it's shameless plug. I've got lots of videos on my YouTube page or on my website, so just type James Murray Finance, and I talk about these things. I've got 60-second short videos that you can look at, and you can go on there and just see more information. There's loads of information of this on my website as well. As I say, there's free downloadable resources on there as well. So if you do need any help on this, or reach out, I'm always happy to have a conversation. We don't charge like an upfront fee for consultation, so always happy to have a chat, answer an email. So if you do need anything, please feel free to reach out to James Murray Finance, and we'll be happy to assist you.
100%. Cool.
Nice one. Well, thanks everybody for watching. As we say, please subscribe. Please share this with any other business owners or anybody that you think might benefit from the sort of things and the conversations that we're discussing. If you've got any topics that you'd specifically like us to touch on or discuss, then please pop them in the comments or send us an email, and we'll be happy to have a chat about it. And until the next one, thanks for watching.
Cool. Thank you.
Thank you.